righty, well, let's go ahead and get started. Welcome everybody to our monthly Money Life webinar. This month, we want to give you our mid-year economic update and forecast. We did one of these at the beginning of the year, and given what's gone on so far this year, we thought we should do another one. If anybody could just maybe raise their hands, let me know that you can see the screen okay and you can hear us okay. All righty, looks like we're good to go. So we've got a team presentation tonight. So you've got the bulk of the Anchor Bay team. I'll be presenting on a couple different topics. And you have Tanner Risley, our portfolio manager, a person who manages your money on a day-to-day basis, is here to give you his outlook. And then we have Blake, our financial planner tax specialist, who will kind of give you a tax update. And then we have a special guest, Ace Azar from the Mortgage Advisory. Ace is has a mortgage brokerage company and a real estate company. And so we asked Ace to come on and give us his take on what's going on with interest rates and mortgages and the real estate market. So we'll all be available to answer questions throughout the presentation. Like I said, if you have a question, just use the Q&A feature or the chat feature, and then we'll answer those at the end of the presentation. Little housekeeping, this is being recorded. And so you'll be able to go back and view it on our website probably early next week. And we'll send an announcement out that it's been recorded. And so you'll be able to go back and view it. So just a little bit about our first presenter. Tanner Risley, as I mentioned, is our portfolio manager. He's been with Anchor Bay for over 5 years. He's the person that looks at your investments on a day-to-day basis. He works with the financial planning team to make sure that he's aware of your cash flow needs and spending needs, so that the money that you need to live off of and to spend is not subjected to market fluctuations. Tanner has a degree in economics from Harvard University, so he's also our resident economist. And we'll go ahead and get this thing kicked off, and I'm going to turn it over to Tanner.
Yeah, thanks, Jim. I'm going to start with where we are year to date in the market, which is unfortunately not a great spot so far. We're the S&P 500, which many of you may know is widely considered basically the U.S. economy, or the top 500 stocks in the US. We're down about 16.1% year to date, and that's as of today's market close. The Dow Jones, which is a smaller index, is down a little bit less, but still down pretty significantly at over 11%. The low, however, was back in mid-June, on June 16th. So since then, the market has been coming back a little bit. And so, this begs the question, was that the low of this downturn, or are we going to get what they call a dead cat bounce, which is where you hit a low and it kind of fakes you out for a second and then it comes down harder. So both kind of on the table, and we'll talk about what it means in kind of each scenario. But in general, with where stocks are right now, basically the stock market is saying they're pricing in somewhat of a worst case scenario. Stocks wouldn't be down 16% if the market thought, the economy was going to grow in leaps and bounds. So the market basically has priced in a significant recession. Should that turn out not to be the case, we might see stocks come back in a real hurry. But that's where we are currently. And here's just a slide quickly on a chart of the S&P 500 and where we've been. You can see in early 2020, late 2019, that's the little COVID drop that we had. And then the government rushed in with lots of spending. The Fed lowered interest rates, and we had a nice growth in 2020 in the stock market in 2021, and then now you can see at the very end there that nice large drop that we've had to start the year. The last high was actually January 3rd, so it was we got one trading day into 2022 up, and then we haven't come back to that spot since then.
And Tanner, maybe just point out, you see that minus 21, that's where we were at the end of June. And Tanner mentioned the market's now, the S&P is now only down 16. So we've had a 4 or 5% recovery from that June low that Tanner talked about.
Yes, hopefully some momentum that we can continue to carry here. Okay, and so this is a nice depiction of different asset classes. So on the top, you can see the vertical columns correspond to the last, 15 years, back to 2007. And all these different colors on here correspond to different asset classes. So everywhere that you see the lighter green color, that's your large cap US equities, like the S&P 500, for example. And so what I'll just draw your attention to, which is kind of already drawn on here, is the black line, which goes through all of these asset allocation boxes. And what you'll notice is they're in the middle. They're never the highest and they're never the lowest. And so what this is showing you is it's always a good idea to have a mixed portfolio, a well-diversified portfolio where you get a little bit of each of these boxes in your portfolio so that you're not taking the highest of highs and the lowest of lows. You can see all the way to the right, the very last column has to do with the volatility. And so you can see asset allocation, that box is third from the bottom, which shows you that it's less volatile than all of those things above it. However, it's still performed in the middle. And so it's really important to make sure that you have a well-diversified portfolio, and that'll help smooth out the ride in years like this. We have done at Anchor Bay a good job so far this year. Just the way our investment philosophy is set up, we kind of lean into dividend paying stocks, defensive stocks, and higher yielding stocks, which is has been an asset class that is performing a lot better this year than the tech and the growth stocks, which have been really hurt this year. And so we've been able to shelter most of our clients from the full brunt of this downturn, which we're very, very pleased with.
Okay, so I'm going to cover the next few slides here. I'm going to talk about digital currencies or crypto. This isn't an asset class that we manage for our clients, but you know, we realize that there probably are some of you on this webinar that may have some of this, or maybe more likely you have your children or grandchildren are invested in this. So we thought we would cover what's going on with this. And so since essentially near the end of last year, there's been a meltdown in this market. Pretty much all of the major players, the Bitcoin, Ethereum, all of those are down quite a bit. In fact, in just the past few weeks, there's been a loss of over $2 trillion of value in crypto assets. As an example, Bitcoin, which obviously is the biggest player, was at 65,000 last November. Depending on the day, I mean, when I first did this slide, it was down to like 22, then it was back up to 24, and I believe today it probably closed somewhere in the 22.5 range again. So wild swings and fluctuations, but it's down significantly in the crypto market. Multiple reasons for that. One is you have this idea of stable coins. These were supposed to act more like a currency, where it was like pegged to a dollar. And so you weren't going to have these wild swings like you have with Bitcoin, et cetera. Unfortunately, a lot of those that were supposed to be stable ended up not being so stable. Some of them actually became worthless. They became unpegged, meaning they're not really tracking the dollar anymore. And so that caused a part of this meltdown. The other thing you've had is a lot of these players have ended up filing for bankruptcy. A lot of them are the exchanges that these things are traded on, and multiple of these exchanges have gone bankrupt. People can't get their funds out; they're locked up. And you've also had a lot of private equity, hedge fund managers, et cetera, buying into these exchanges and to cryptocurrency. They've taken huge hits with the bankruptcies, et cetera. And so there's been just a major meltdown in the crypto market. It reminds me very much of the tech stock bubble that we had in 2000, where we had a lot of the e-commerce stuff was just starting. And so you had players like Amazon and Google and some of those that, at that time they weren't profitable. We didn't know if they were going to make it. And then you had the pets.com and some of these others that ended up washing out. So this very well could be a washout where you're going to only be left with the major players that have some financial stability to them. It could very well be, and I don't think it's known at this point, that there's a realization that this whole idea of the crypto markets isn't viable, and that it ends up just most of them melting down. The other thing that's happened is a lot of people thought that crypto would be an inflation hedge. And obviously we've had the spike in inflation, and you can see, these things are down 40, 50, 60%. So it hasn't worked out to be the inflation hedge that a lot of people thought. And so we track it. We're fully aware of what's going on. As I mentioned, this is not something we're going to recommend to the bulk of our clients. It's just way too volatile. It's still largely unregulated. And so, we're not going to recommend it. But if you have it or you're interested in it, certainly feel free to discuss it with us, and we can give you our thoughts on whether it fits into your portfolio and allocation or not.
Yeah, Jim, can I add to that real quick?
Absolutely, Blake.
Yeah, so I think Warren Buffett put it best, the legendary investor: only when the tide goes out do you discover who's swimming naked. So that famous quote of his kind of speaks to what's going on in the crypto arena right now. A lot of these crypto hedge funds is what they're called these days. They've been exposed for the fraudulent activities that they've been doing, and they've been over levering the crypto assets. They've been lending them out to their clients, and clients have seen this. They pulled out their crypto assets, and the dominoes just have started to fall, and that's caused the decline in crypto. So it's just been a snowball of repercussions and negative circumstances that really has led it to decline the way it has.
Yeah. Okay, so Tanner mentioned that the market is kind of priced in the probability of a recession. And so I'm going to just talk briefly about the prospects for a recession, and then Tanner will go into a lot more detail about what may cause that, et cetera, in terms of interest rates and inflation. So in the actual term recession means that we've had 2 consecutive quarters of negative growth domestic product, meaning that the economy had negative growth for 2 quarters. So now Q1 was negative, and so we've already had the first quarter. We're waiting on Q2. That comes out next week, 7/28. And so if that's negative, then in theory, we're already in recession. And so, the market's anticipating that's going to happen. It very well could be that Q1 and Q2 are the end of the recession as well. On the next slide, I'll show you kind of the normal time frame for recession. So it could be a very short-lived recession, or it could be that we're not in it yet and it's still hanging out there. or it could be this is the start of something that's more prolonged. A lot of that, I think, is going to hinge on the Federal Reserve and whether they can walk this tightrope between curbing inflation and avoiding the recession. The Federal Reserve at this point is still expecting the rest of the year to have positive growth. Not great growth, but positive growth, 1.7%. So the indications right now are that either we've already had the recession and it's over, or that we're going to avoid it. But a lot of that is going to hinge on what the Federal Reserve does. They're walking this tightrope while trying to raise interest rates to curb inflation, but at the same time not raise them so much that they end up throwing the economy into recession. So just to kind of give you a depiction of recessions and expansions. So if we look at the left-hand chart there, you have the gray bars. Those are periods of expansion. So that's where the economy is growing. You can see that last one we had, was the longest we've ever had. I mean, the average is about 4 years. The last one we had that started in 2009 at the end of, the Great Recession, essentially went almost, 10, 11 years. So it was the longest one we've ever had. We had a very short, brief recession, which is this kind of this bubble over here at the end, caused by COVID, where we essentially shut down the entire economy. And so we had a dramatic decline in gross domestic product, down 10.1, but it was short-lived. It didn't last very long. It was less than a year. The last one, the big financial crisis that we had, that one lasted a little less than 2 years, and we were only down 4. So you can see, recessions are few and far between, and they're short-lived. Like I said, the average recession is a little over a year. And then from there, we typically have a period of extended expansion. We've been in expansion since we had that brief decline for COVID. And at this point, we don't know yet if it's the end of this expansion and we're back into a recession. That's uncertain at this point. And like I said, a lot of that is going to hinge on what happens with the Federal Reserve. And so what the Federal Reserve's trying to do, and this is very tricky, and they've pulled it off before, but we don't know at this point, and this is what the market is kind of pricing in, is that it may not happen, is the idea of a soft landing, where they will raise interest rates just enough to slow down inflation. And Tanner's going to talk in more detail about inflation, to slow it down, but it keeps the economy on track. It doesn't throw us into recession. What could happen is that the rate increases slow the economy so much to curb inflation that it throws us into a larger and more prolonged recession. That's the big unknown at this point. And so they're trying to walk this tightrope with just gradual interest rate increases to keep inflation in check, but not so large that they throw us in recession. This is what we don't know at this point as to where we're actually going to land. So I'm going to turn it back over to Tanner, and he can talk about what's going on with inflation and interest rates, et cetera.
Right, and the last part of that is if they raise rates too slow, we're just going to keep seeing crazy inflation, and that's no good for the economy either. So we've seen inflation for a number of reasons. It was at 6.9%. So inflation is when we say 6.9%, that's referring to this CPI, which stands for Consumer Price Index. And it's basically an index of a basket of goods where they take prices and measure them over time to see how much they're increasing or in some cases decreasing. So we were at just under 7% at the end of 2021. We've continued to see some supply chain issues. The very obvious and biggest one is that everyone is feeling is the spike in energy prices. We've got low unemployment rates, although those are just now starting to creep up a little bit, but still historically very low. And you've got obviously the war on Ukraine, which is again affecting a lot of supply chain issues, including the energy and oil and food issues. So a lot going on. You've also got, we have had, before the Fed started raising interest rates, historically low rates, which is also helping the inflation, as well as you've got a huge spending bill and the US government throwing lots of money into the system when COVID hit in order to stave off a huge recession there and try to keep people's lives normal. We're kind of seeing the unintended consequences of that right now. Okay, and so this is a graph showing inflation and the CPI index. You can see the bars, the gray bars there indicate recession. And what you'll notice is those lines, the squiggly lines, decreasing during that period. And that's basically the Fed lowering interest rates and therefore prices relaxing and coming down real hard. This graph goes up until May. You can see May, we were all the way up to 8.5, and June came in actually at 9.1. So the latest numbers are still the highest. So we're still waiting to get, many economists thought we were going to see the peak in May at 8.5, and then June came in at 9.1. So we're still increasing right now. We'll see what happens at the end of July, and when they get those numbers, many think again that we finally hit the peak in June. So hopefully that is the case. Okay, and so the impact of inflation, there are a few good things that come from it as you raise prices and everything. It's good for income typically. You can expect wage increases and with Social Security and pensions, you'll see those cost of living adjustments. However, there's a lot of bad with inflation. Price increases on everything that you need to live, food and energy and things like that. Staple goods go up a lot, and the most obvious one again has been gas prices this time around, because not only are they increasing because of the general rising prices, but also because of the war on Ukraine and supply chain issues. Okay, so rising interest rates. Let's talk a little bit about this. So interest rates is it's a tool. Changing interest rates is a tool that the Federal Reserve can use to curb inflation or basically influence the economy. And they do this when you lower rates. It basically affects the growth of the economy. So imagine you've got a company that is considering expanding a manufacturing plant. Let's say they're thinking about buying a plot of land, building a building, and hiring a bunch of people to manufacture their goods there. Well, that costs money. And a lot of times businesses don't have that kind of cash on hand. And so they'll look for financing options. And so imagine if you're a business and you can get that at 3% versus, now with where interest rates are, those rates are going to go up a lot more, which makes it, one, harder for the businesses to manage those loans, and two, just more expensive in general because they're having to pay higher interest rates for those expansions. It makes businesses think twice about taking on those risky growth opportunities, and that ends up stifling the economy. And that's just kind of one example of how rising interest rates can affect things in the economy. Interest rates are just the cost of money. It's literally the cost of borrowing money, how much it affects, you know, a business or whatever individuals. It all comes back to interest rates and how much you're being charged to borrow that money. And so as interest rates go up, there's just less demand for it. And you'll see that flow through the economy. Okay, and so now I'm just going to talk about where the Fed has been and where we're thinking they're going with interest rates. So the Fed has been raising interest rates since they dropped them down to near zero during COVID. So the Fed does this thing where they target basically between a 0.25% range. So back during COVID, they lowered interest rates all the way down to, they were targeting 0 to 0.25%. They've since raised a few times, and now we're at 1.5 to 1.75%. They have a meeting coming up on July 27th, which is next Wednesday, where they're expected to increase 0.75% again. So that would bring us to 2.25 to 2.5%. The expectations for this interest rate rise have changed over time. Originally, the market was expecting only a 50 basis point increase, and then we got those huge CPI numbers in June. The market was only expecting us to get a CPI number in the 8% range, and it came in at 9.1, which made everyone think, oh, they have to raise rates by 1%. The latest numbers that have come out, we've seen a little bit lower of employment numbers and some housing stuff that has caused the market to think, okay, maybe actually we're settling in at a 0.75% rate increase. So that's kind of where we landed right now. And here's, so this is a chart of the Fed funds rate, which is the interest rate that we're talking about. So we say the Fed's going to raise interest rates. What does that mean? We're talking about the federal funds rate, which is what is depicted in this chart. And that's kind of the interest rate that all interest rates start from. So you might think, how does the Fed affect an open market, right? Credit card companies or banks and everyone loaning money gets to choose their own interest rates. The Fed can't mandate things here and there. So how does it work? Well, the Fed funds rate is the rate at which the Fed lends money to banks. So they get to set that rate, and then every other interest rate from there kind of flows through the economy. So imagine if you're a bank and you have to pay more to borrow from the Fed. Well, guess what banks do? They pass that on to everyone else. And so just about every interest rate in the market comes from banks. And so after the Fed raises their rates, banks pass that cost along to us, the people borrowing in the economy, and you'll see industry-wide, economy-wide raises in interest rates. So that's basically how the Fed is able to kind of control the interest rate environment of an entire economy without actually mandating anything. It just is kind of the way the supply chain works on the interest rate side.
Sorry, I unmute here. So obviously one of the things that, these interest rate changes are impacting our home mortgages, and which it will impact obviously the real estate market. So we've asked Ace Azor to come on and talk about what he's seen in terms of mortgage rates and the trends and what it's doing to real estate inventories, et cetera. Ace, his contact info is on here. So if you have questions for Ace directly, you can reach out to him, and it'll also be in the chat, because Ace isn't affiliated with Anchor Bay. He is just someone that some of our staff has used personally, and we referred clients to, and we're very comfortable with his service and his offerings. And so, we rely on Ace to provide some guidance and leadership in this area. So Ace, I'll go ahead and turn it over to you.
Well, thank you so much, Jim. Can you guys hear me okay?
Yep.
Okay. So I wanted to talk about just some simple things. There's a lot of obviously noise in the market with the interest rate increase. And so I wanted to talk about some of the practical, simple things that we can do that are still available to us, specifically as it pertains to mortgage and real estate, that we can do to save money. So one of the things that we are seeing, even though the interest rates have gone up, is an increase in borrowers or homeowners looking to lower their overall cash outlay. So what that means is debt consolidation refinances still have a place in this market, even though interest rates have gone up significantly. I like to give an example of, we have a client who recently closed on a transaction, and her interest rate went from 3.625% up to 4.875%. Yet she was still able to save a substantial amount of money because we were paying off debt. So in her case, we paid off about $72,000 worth of debt, and the payment that she was, so that $72,000 covered about $1,000 worth of debt that she was paying monthly. So fortunately, values are still high enough for people to go in and tap into that equity and still find some benefit. In this lady's case, her mortgage payment was $1,500 a month, and she had that additional $1,000 worth of debt that she was paying on it. So she had a total monthly cash outlay of $2,500. Once we were able to pay off that debt, that $1,000 per month, that came down to $500, right? So she saved $500, even though her interest rate had gone up over 1%. So the funny thing about that is we were talking and I was congratulating her. I'm saying, hey, you saved $500. That's really great. That's awesome. And she laughed at me and said, no, I'm saving closer to $3,000, because what I didn't mention is she took cash out as well. And she paid off some private debt that was not showing on her credit card. So she was able to eliminate some high interest private debt that, in addition to the debt that was showing up on her credit report. So that was huge. And I'm seeing more and more people raise their hand about eliminating and doing debt consolidation. Particularly in these type of markets, interest rates go up and people start to panic. People do feel like they may have missed the boat. They may have missed the market, say, hey, I should have done that refinance or paid off those debts a few months ago. But I'm here to tell you, at least now in Q2, and I believe in Q3, we know that the rates are going to continue to creep up. We may see 7% at the end of the year. We take that in consideration. However, there are still opportunities with the debt consolidation refinance. So that's one practical thing that we can look into as a potential option for saving money. The next potential thing that we can do is consider the biweekly mortgage, right? This is not a new concept. It's something that we talk about here at the Mortgage Advisory often. And we get our clients to set up on a biweekly mortgage as much as we can. Most of the time on a mortgage, you get 1 to 2 months off after completing a refinance, and even on a purchase. You can take that month and make it work for you by actually making a payment, a full payment, and then moving forward with bi-weekly payments after that. Bi-weekly payment system, if you're not familiar with it, essentially you're just cutting mortgage payment in half. So instead of making one mortgage payment per month, you're cutting that in half and you're making 2 payments. And So over the course of a year, instead of making 12 payments, you're making 26 payments, which equals one additional payment per year. And this is powerful. It's amazing because that one additional payment per year can shave 5 to 7 years off a 30-year mortgage. So you're able to manipulate the principal and the interest just by making a biweekly payment. So the other side of that, some lenders have gotten wind of this over the years, and they'll put some measures in place to maybe charge up front to set up a biweekly or a weekly payment system, or they are just not offering it at all. But I have seen most lenders in today's market, they are open and actually are offering and encouraging borrowers to look into making a biweekly payment or even a weekly payment. So in this market, we haven't seen, Tanner, I think, mentioned earlier, the employment is still pretty steady. So homeowners, if they're not losing their employment, there's still options out there for them, right? Just to pay down normal debt, bi-weekly payments, and as I mentioned, the refinance debt consolidation option. You want to be out of debt in this type of environment. So that's what I wanted to say in regards to that part of it and just saving money. So the next thing,
just a question for you too. It's like, as interest rates rise, it probably makes a little more sense too to maybe make some extra principal payments. If you're not going to go to like bi-weekly, at least add a little extra principal. Probably didn't matter much when someone has a 2.5% loan, but if they got a 6% loan, that can have a pretty big impact, right?
Yes, and that's what I was mentioning. So when you do either any real estate transaction that involves a mortgage, there's usually going to be a 30 to 60 day window that you would have without making a payment. And that's what I was trying to touch upon. It people can actually take advantage of that window by making either one full payment, because they've been making the payments the whole time, or if it's a purchase, most of the time they would have enough reserves to just make one full payment. So that's one option. That's very, very powerful, because that not only does it, if you're doing biweekly, add to that, now you can turn it into 2 payments in 1 year if you were to take advantage of that additional month. So yes, if you have income and you have enough savings, you can just add a full payment as well as the biweekly, just to get more power out of that, the interest, out of manipulating the interest and lowering the principal by making those payments. So remember, I always tell people, loans are set up on 30-day cycles, right? So if we can cut those cycles in half, then we are able to essentially manipulate the principal and the interest rate with the frequency of payment. And that's why terms exist. So the next thing that I wanted to talk about, and Jim mentioned, I think he has the slide up here with the interest rates and what we're seeing in the real estate market right now. All right. So obviously rates have gone up. We're seeing some people fall out of escrow, especially in March and April, when interest rates really took a hike. We saw people falling out of escrow because they could no longer afford the payment that they were set up or pre-qualified initially for that property. So that was something, it was a shocker, and we're still seeing a little bit of it. If you were prudent mortgage bankers and loan officers would have locked those rates. But a lot of times we got into a habit over the years of floating rates, because we figure, hey, we'll have opportunity throughout this process to lock that rate. Well, in March, April, and even a little bit in May, we've seen some disastrous results on purchases with people who were floating their rates. And so they wound up getting jacked up prices, and they were no longer able to afford the rate. And to something I think Tanner mentioned earlier, or may have been Jim, but interest rates have always pretty much been the same. It's the price of the rate that changes, right? So now we're seeing interest rates, we're quoting interest rates at 4.875, hovering around that 5%. That would be par. So I get clients often, and people call and say, hey, I want to buy it down, to 4.25. that rate exists, but the cost of it in today's market is just so expensive that it may not make sense. It may not make sense. So just wanted to touch upon that part too, because I think that's very, very important for people out there to understand how interest rates work and as it pertains to mortgages. It's the cost of the rate. So when we consider ourselves doing our borrowers a favor, we're presenting par rates. So that's a rate that doesn't cost them a lot of money to buy it down. And it's no huge credit, on our end as well. So it's kind of par just in the middle. Another thing that we're seeing that is very, very important in the real estate side of things is the inventory, right? So we all know that inventory is showing up on the market. In December, there was, I believe I have a statistic here, there was 17,500 homes on the market in December of 2021. Right now, to date in June, there are 31,000 homes on the market. This is for the entire MLS here in California. So the inventory is almost double. It's almost doubled. So it's very interesting in 6 months. So what that means for buyers and sellers is pretty interesting. And essentially, we all know sellers are going to have to reconsider their mindset, right? When they're considering selling a property. Properties that were sat on the market for 3 days, 7 days, 6 months ago are now sitting on the market for 10, 15, 20. I have a listing, it's been sitting on the market for 35 days, right? And so it really comes down to the mindset of the seller and making that adjustment to the current climate. There's a statistic from Zillow that I have here that shows that if a seller reduces his price by 15% of the market value, he opens up a buyer pool, a 90% buyer pool. So 90% of the buyers on the market now become available to that seller by lowering his expectations by 15%. By 15%. So that's a very powerful number in terms of being able to get that property sold in a timely manner, which most sellers want to do. So I would suggest that sellers do, if you're thinking about selling in the market, that's a huge consideration to think about making that adjustment. 10 to 15%. 10%, the statistics shows that it opens up 75% of the buying pool now becomes available at a 10% decrease or discount of market value prices. And when we say market value, we're looking at the standard comparables that you get from Zillow, Redfin, or any of the other sites that are displaying values. So another thing that I'd like to talk to about sellers that they can do to help to sell their property fast and kind of make the mental adjustment to the market is to begin to offer seller concessions, right? We're seeing that already. We have clients on our pipe. We have a couple of purchases in our pipeline right now, and the sellers are saying, hey, we'll pay for the close. We'll give the buyer 10 grand to help out with his closing costs. So that is huge incentive. Just 6 months ago, a buyer he'd be, happy if they even looked at his offer, right? So there is still competition in the market. Sellers' prices are still high, relatively, high. In California, the average sales price is still $800,000. So what we are seeing is a correction, which is a healthy correction, but it's not the decline that a lot of people who may sit on the sideline and say, hey, I'm waiting for this crash before I get in. I'm not sure we're going to see the type of crash that we saw in 2008 and 2009. When we were writing loans back then, there were a different standard and a different quality of loan. So now most of the people who are in these products, they have stable credit. They're Fannie and Freddie sellable products. So I don't foresee values just falling off of a cliff, but we do see a decline, a steady decline, and some stabilization, which I believe is healthy in the market. So what this means, the high interest rate environment and the additional inventory on the market, what this means to buyers, it could be a good opportunity to enter the market. For one, since there's more inventory on the market, there'll be less buyers to compete with, right? So there's more homes for sale, less buyers to compete with, and more negotiating power on the buyer side. So I think that's a plus. And moving forward, we're expecting Q1, Q2 of 2023, there are going to be a lot more buying opportunities. So even though the affordability has come down, like what we see on the slide, there's still tremendous amount of opportunities moving forward. And to speak to the affordability, it's like it shows on the slide, a $500,000 loan at 3% last year was $21,000. So now that same loan, 500,000 at 5%, hovering around 5%, is $2,700. So we know that the affordability has come down, but that we believe will be mitigated with the decrease in values as well. So it may not be, again, a super crash to where the market comes down more than say 25%, but that is a possibility. And if you're on the sidelines, now you want to start talking to your loan guys and your mortgage professionals, your real estate professionals, to start prepping for potential opportunities that are going to show up at the fourth quarter of 2022 and what we expect in Q1 of 2023, as well as Q2 and moving forward. If we are in a true recession that lasts more than a year, then there will be even more opportunities for buyers moving into Q3 and Q4 of 2023. So I always look at the bright side of things. I don't think this is all bad. I think overall, this is healthy for the market. We have been floating with low interest rates for quite some time. And I've been in the mortgage business for over 20 years. And when I first purchased my property, the interest rates are 7%, 7.5%, right? So just to, that puts things into perspective. We're still fairly relatively low in terms of interest rates over the years. I remember in the 80s, my mom, interest rates got up to, 12, 13% or something to that effect. So I think there are opportunities out there moving forward. And so those are some of the things that I think that we as sellers can consider, as buyers, we should think about, and homeowners just in general, as options and opportunities that we should really look into in this current market.
Yeah, Ace, just to interject, so we've got, if you see the slide that has like how average interest rate, housing inventories, et cetera, we've really been spoiled with these interest rates. I mean,
Oh my God.
20 years ago, as Ace pointed out, you would have been thrilled with a 5.5% interest rate. I mean, my first mortgage, and I'm sure probably a lot of you on this webinar, I had that 12.5% interest rate in the early 80s.
Right.
And so we got spoiled with these 2.5% and 3% mortgage rates. But, for someone who's just going to be buying their first home, et cetera, 5.5 is probably in this, the long-term scheme of things, not a bad rate.
Not a bad rate at all. And
to Ace's point, especially if housing prices, become a little more normalized, so you're not paying extra money for the home and having a 5.5% interest rate. So, interest rates are relatively still a good deal.
Yeah.
And we'll see where the Fed goes. It very well could be that they'll drop again.
Yeah, it very well could be. I mean, nobody has a crystal ball. We're prepping for maybe 6.5%, 7% by the end of the year. And so for first-time home buyers, that obviously the affordability comes into play. But the people who can afford it always say the best time to buy is when you can afford it, right? Because if you're able to survive the turns, then you'll have opportunities. If they do decrease interest rates, or if interest rates stabilize, you'll be able to refinance and lower that rate at that time. So that's kind of what we're seeing.
All righty. Well,
so yeah, we'll have questions for Ace at the end. Again, you can just throw them in the Q&A or the chat. I'm going to turn it over to Blake. I think many of you know Blake. He works with me on the financial planning side of things, also prepares many of your tax returns. So he's going to kind of give an update on what's going on with tax legislation. been kind of a quiet year compared to the last couple, but there is a Secure 2.0, which is on the radar. So Blake's going to kind of give you the latest on that.
Yeah, switching gears a little bit. Thanks, Jim, for the introduction. So as we've learned thus far, there's been a new proposal, Secure Act 2.0, setting every community up for Retirement Enhancement Act 2.0. You'll notice it's 2.0. So this is meant to build off the first Secure Act that was passed in 2019. So this is a secondary version, a second layer. The nuts and bolts of it is, at this point, it's not law. It's been passed in the House of Representatives, but it's still working its way through the Senate. So nothing's official. If it does make its way through the Senate, then it'll move on to the president for the final sign off. Know that there might be some iterations and work throughs through a lot of the provisions that I'm going to go through, but what we're going to talk about here is the most important ones as they apply to the majority of Americans. So the first one that we'll highlight is a raise in the required minimum distribution age to 75. So as a refresher, for those that have IRAs, qualified retirement accounts like a 401k, you're required to take money out of that account once you reach the age of 72 is what it is currently. They're talking about bumping up that age to 75. And we put in parentheses here, ultimately, because this is going to be a gradual transition is what they're talking about. So what they've discussed is to bump it up immediately to 73, and then they would move it to 74, perhaps in 2029, and then ultimately 75 in 2032, a decade from now. So the end goal would be to get it to 75. And a couple pros and cons with that. The advantage would be you have more time to do things like Roth conversions and not face the taxes by the required minimum distributions up until age 75, but by them delaying to age 75, that means you're going to have to take a larger amount because the life expectancy is going to be shorter. The next major provision that's going to apply to a lot of people, which would be a big win, is making the Roth bucket more accessible. So specifically, they're thinking about allowing people with a simple IRA or SEP IRA to make Roth contributions. So as a reminder, with simple IRAs and SEP IRAs, you can only contribute pre-tax. So the money that I put in lowers my taxes. Roth, on the other hand, are after-tax contributions, but the primary advantage of Roth is it's after-tax up front, but when I take the money out of it, it's tax-free. So we always like to build up the Roth bucket, and it's really pivotal when it comes to retirement. So they're talking about allowing you to contribute Roth to the simple and SEP, which is not currently permitted right now. The other potential Roth change is employers having the option to do matching contributions into a Roth 401k. So if I'm an employee and I contribute to my 401k, the matches I get from my employer, that goes into the pre-tax bucket. They're talking about allowing employers to direct matching contributions into my Roth 401k, which would be a huge win for employees. Again, the goal here is to build up the Roth bucket, which would be very advantageous for everyone. The next major provision is an increase in the catch-up. And when I say catch-up, so as of 2022, if I'm age 50 or older, I can put an additional $6,500 into my 401k or 403b as a catch-up contribution. So this was inflicted to allow those close to retirement to plug away more towards the 401k as the runway is shorter. They're talking about increasing this catch-up contribution to $10,000 for 401ks, 403bs, and 457 plans, and then $5,000 for simple IRAs or simple 401k plans. The actual age that it would be determined is still being talked through. So it might not be at age 50, it might be 62 or 64, but the main point is that it would allow people to plug away more towards retirement, direct more towards their 401k, and ultimately maybe lower their taxes if they do pre-tax contributions. The last one that I'll talk about is student loan matching contributions. And it's a little hard to understand by the definition, so I'll give you an example, but essentially it's allowing employers to match contributions to a 401k based on what an employee pays to their student loan. So Johnny Boy graduates from ABC University, and after his graduation, he now has to pay $500 a month for his student loan payments. since that's daunting on Johnny, he can't contribute to his 401k and his cash flow strain from that standpoint. So what they're talking about is allowing employers to essentially match Johnny's payments to a student loan and put that in Johnny's 401k, irrespective if he even contributes money. So his employer in this example would be able to contribute $500 to his 401k, the same amount that he's paying on his student loan, which would give Johnny some help, some reprieve, because a lot of students that graduate, they come out of college, they have mountains of student loan debt. It's hard for them to pay off their student loan and contribute to their 401k. So it could be a big win for employees. And then some other ones not mentioned here, I won't go into the details, but they've talked about eliminating the early withdrawal penalty for individuals that take money out of retirement accounts and use that money for, let's just say, birth or adoption expenses, and they're under the age of 59 and a half. And then the other would be an auto enrollment feature for 401k plans. But these 5 ones right here that we've listed, these are the core ones. These are the key takeaways. And again, it has not been officially passed, but we're monitoring here at Anchor Bay. And if it does look like it's going to get passed, that we'll be doing another webinar and we'll talk about more specific planning opportunities to help you out. And now I'll pass it off to Tanner and he'll talk about our current investment strategy right now.
Yep, exactly. Thanks, Blake. We're going to finish up here with what are we doing? What is Anchor Bay doing given, now working back to given the economy and the market and all the things that we've talked about. What are we actually doing? So I'll start on the fixed income side of things with bonds. We're currently sitting tight for the most part. With an expected interest rate raise coming next week. If we just wait it out a little bit here, we might be able to pick up some higher yields on bonds, more interest, and a little bit better return if we wait. And this might mean keeping a little bit of extra cash on hand, ready to take advantage of those higher interest rates when they come. So there might be a little bit higher of a cash holding in the short term. But it's basically earmarked for bonds once we get this Fed interest rate raise. And then what about stocks? So right now we want to be careful with where the market is in this kind of limbo state. We're about to find out if we are in recession. We're about to find out if the Fed is right about its growth projections for the rest of the year. We're not selling in this market, but we're also don't feel like it's the right time to be making huge bets because there's a lot that going forward, there's a lot of directions the market could be going to. And so we don't feel like it's a good time to be buying in large swaths. So we're monitoring everything, being very careful in our investment decisions. That being said, there are still some stocks that we feel like are at good prices right now. With the market being down, there's lots of stocks that are still doing really well. The company is still earning really well. They've got lots of cash, great fundamentals, but they're just being dragged down. The price is being dragged down because people are wholesaling on the market. And there's really nothing that specific company did to earn the depreciation and stock price, but they're just being dragged down because everybody is selling all stocks. And we like taking advantage of that because we feel it's a misprice in the market. And so right now, the safest bet for these is these defensive oriented stocks. And when I say defensive, I mean they tend to hold up better when we're in recession or when the economy is struggling or when the stock market as a whole is struggling. They hold their value more. These are sectors like consumer staples and healthcare. You think about these sectors, companies like Costco, Procter and Gamble. People are going to go to Costco whether the economy is doing well or whether the economy is doing poorly. People are going to pay for their prescriptions and their medicines, and they're still going to go to the doctor because those are things that people need literally to survive in some cases. And so healthcare is another good sector for investing in when the economy as a whole is struggling. Additionally, I'll add, financials typically aren't thought of as a defensive sector. However, we are considering raising our allocation to financials as we see this raise in interest rates. Banks have this unique situation where interest rates are rising, so you'll see your if you go out to buy a new car, your auto loan will be higher. We talked about mortgages and how mortgage rates are going up. Basically, all of these interest rates that banks charge are going to be higher. Think about like the variable rates on your credit cards, and they give you those ranges when you sign up. They're going to start to move towards the higher end of those ranges. You'll see on your credit card statements. But what they don't do is raise the saving account rates that they pay out to you as much. So they're going to raise their auto loan rates and the mortgage rates and these credit card rates by 2 and 3%, and in some cases maybe more. But they're not going to raise the rate that they pay you on your savings account, unfortunately. Not as much, at least, as what they're doing on the other side. And so this helps their margins. So financials may be a good place to put some money in small increments right now in the stock market. And as always, dividend yield is very important. We have always, as I mentioned earlier, taken a kind of a tilt or an emphasis on stocks that pay a dividend yield. And it's especially important right now when there's a lot of uncertainty in the stock market. Dividend yields or dividends in general are more stable. They're more predictable than trying to predict where a stock price is going to go. There's a lot more volatility in that. With dividends, typically companies try to state a dividend and then pay it for the rest of the year, and then they always try to raise it. That's kind of the going norm that the market has grown to expect, and it shows really poorly on you as a company if you ever decrease the amount of dividend that you're paying. So this means companies will really put a lot of focus into making sure that they continue to maintain that dividend no matter what's going on with the stock price. And so us focusing on that as a way of generating a little bit of a return in this uncertain market is what we're doing right now. And then we'll just kind of wrap up here. Downturns are a normal part of investing. Just like Ace was talking about in the housing market, you can't expect things to go up forever. And we always know we build our portfolios with these downturns in mind. So whatever your financial goals are and however long you have to invest before you're going to need the money in the account that we're managing, we've taken all of that stuff into account when we've decided what investments to put in your portfolio. And we look ahead and we think, okay, so if we got into a downturn, would this person be okay? How would these investments that we've chosen for them perform? We do this all ahead of time so that we're not panicking in a time like this. We feel very confident with where we are so far this year, and it allows us to not get into a panicky situation where we feel like we need to sell to protect on the downside, or we need to make drastic moves. Another important thing to remember is losses are unrealized until we actually sell the investment. So you might see a stock come down. Let's just take Apple as an example. Apple's the biggest company in the world, and we have lots of confidence in them getting back to their all-time highs. They're still down a significant amount from whenever they made their last high, which was probably somewhere around January 3rd when the whole stock market made its last high. We have confidence that Apple will eventually get back to that level. And so as long as we stay in that investment until that point, we should get to participate in that comeback. And that's why it's so important to stay invested, because we're confident eventually we're going to get back to those highs. And if you don't have time to write out the ups and downs of the market, we didn't put you in harm's way in the first place. And that's part of our job as advisors, is knowing your individual circumstance and making sure that our investments are catered to that individual circumstance. So again, kind of wrapping up here, we're very happy with where we are in the market right now, and we're always happy to take your questions and chat about the ongoings in your portfolio and any questions you may have.
And we do have a couple questions. So if you have questions, feel free to put them in the chat or the Q&A. And so we had a question for Ace. So the person asked, I make my payment at the first of each month, 30 days in advance. So on July 1, I make my August 1 payment. Is that getting the kind of the same benefit as the bi-weekly plan that you mentioned by paying it early?
So no, to answer that question, it does not, it doesn't decrease the interest. In many ways, it can actually, if there's 31 days in a month and you make your payment on the first, then you wind up paying an extra day in interest. So that is not the way that the biweekly strategy would come into play, but it is a prudent thing to do, right? So if you were in a refinance or you were doing a transaction, that would be a prudent thing to do. And if we were to close, say, the second day after you made that payment, then you would have that month of interest paid in advance, and then you'd have the month following without a payment. So at that point in time, you could step in and make a full payment for the month that you would quote unquote have off, which you never really get off. It's just the interest is paid out through the loan. That would be a power play in terms of buying down or mitigating some of the interest that would accrue over 30 days. I hope that was helpful. That made sense.
Yeah, thank you, Ace. So we have another question. We have someone who planned to buy I-bonds, and if you're not familiar with I-bonds, reach out to us so we can talk about those. As of right now, that's probably the absolute best investment you can get. They're currently yielding 9.2%. They're guaranteed by the U.S. government. There's a few kind of fine print stuff that you need to be aware of, but they're a fantastic deal right now. So the question was, they hadn't bought them yet. Should they wait to see what happens when the Fed rate raises their rates, or should they just jump in? Tanner, Blake, you can correct me, but they only reset twice a year, I believe.
Correct.
So
Yeah.
I don't think this current Fed rate increase is going to impact the rates you're going to see on I-bonds. I think the next one is November.
It's October. Yeah. So it's
October.
based on the rate of inflation, not the Federal Reserve interest rates, and it resets twice a year, October and April. So we'll just wait and see what October brings from an I-bonds rate.
But I would add that my recommendation would be to not wait, because as soon as the Fed does raise interest rates, they're doing that to curb inflation. So you will see the raised interest rates and inflation should start to lower. So the sooner you can get in and start getting that you'll get the 9.1 or whatever the rates are currently until October, like Blake said, and then it will probably, most likely, and hopefully actually be down, because that means that they're actually starting to curb this inflation. Good for the economy, not good for your I-bond, but I would say try to jump on it sooner rather than later, because when the Fed does raise rates, we should see the return on those I bonds start to go down. But it'll be gradual. I mean, even if it goes down back to 7% for the next 6 months, and then it goes back down to 5 for the next, those are all incredible rates to get from a government issued security, which is one of the safest places you can have your money. So definitely still a good investment, even if it does drop to 7, 5, 4. But I wouldn't wait. I would try to jump on it sooner rather than later.
So any other questions before we wrap up? We appreciate everybody hanging in there a little bit longer. As I mentioned, this has been recorded, and so it will be posted to our website sometime next week. We'll inform you. And then if you do have other questions, don't hesitate. Reach out to myself or Tanner or Blake. And then, mortgage and real estate related questions, reach out to Ace individually. As I mentioned, he's kind of a trusted partner, but he's not affiliated with Anchor Bay, so you can reach out to Ace for any questions. So with that, we'll go ahead and wish everybody a great evening. We'll have another one of these in August. We'll announce what the topic will be in the next couple of weeks in our monthly newsletter. And as always, anytime anybody has any questions, concerns, you want to talk about your portfolio or anything else, don't hesitate to reach out to us. We're always available.
Yep.
Everybody have a great evening. We will talk to you soon. Bye-bye.
All right. Thanks a lot, guys.